Hi, this is Alan Gassman, and Brandon Ketron and I welcome you to this presentation, Planning to Protect Medical Practice Entities and Income in View of the New Tax Laws. I've got a confession to make here. I thought that preparation of this outline was going to be a lot easier than it turned out to be. This is a challenging topic, especially on the income tax side, because we've really tried hard to boil it down so that you can see each element of what we're talking about very clearly. So we are going to go over 30 minutes, but what I'm going to do is I'm going to record everything past 29 minutes and post it to YouTube tonight. So if you need to leave early, you can tune into YouTube tonight, and you'll want to view the one that's called Starting at 29 Minutes, if you see the first 29 minutes. Also, please email me at agassman@gassmanpa.com, as you see on the screen there. Any questions, comments, or suggestions that you might have. If there are any corrections or good ideas, we'll send an email tomorrow to everybody who's attended this webinar. Now, flipping the page very quickly, we obviously have a lot of things going on. Tomorrow at 3 p.m., we'll be talking for Lineberg Information Services on estate planning for especially large estates, if you're interested. And next Tuesday, we'll be speaking at 12:30, another free webinar on the flow-through tax, which will go into more detail on the flow-through tax than you're going to get today. If you would like to support any of the organizations that are silly enough to let me speak or to let us speak, please do so. You've got some of our calendar items there. Also, the Creditor Protection of Florida Physicians book is available. It has not been updated for the new tax law, but it is still very useful. If you send me an email, I will send you the book with a self-addressed envelope, and you can put a $10 bill in that envelope and send it back to us. So the next page, we do have the invite for the Lineberg system. If you have that on the PDF that you would have received from us today, you can just click there. And then the next page is the invite for the flow-through entity webinar on Tuesday. Page 7, you've seen this before. If you've seen me before, it wasn't raining when Noah built the ark. So just this morning, I had a 2-hour meeting with a CPA and a very bright and inquisitive physician. And we talked about a lot of the things we're talking about today, and we decided to get together again in 30 days when we knew more about some of the issues we're going to talk about today. So please don't consider this to be the last word, but please do plan ahead. And don't run over any dolphins with your ark. So first, we're going to talk about optimizing corporate tax, pension, wage, cash, and individual tax planning. And at page 9, there is no substitute for a good certified public accountant. There really isn't. We work with a lot of certified public accountants, but we do not work without them in income tax planning. Please keep that in mind and be kind to your advisors. Page 10, we're going to talk about some basic principles here. A lot of you know a lot of these principles, but a lot of you will appreciate the recharge anyway. Number 1, under the new income tax law, those who reach the highest bracket are going to be at 37% instead of 39.6%. We're going to show you a little bit more about that later. Normally, your K1 income from an active business is going to be also at the 37% bracket if you're at the highest bracket. Your rent income can also be at that bracket, your interest income at that bracket. Your long-term capital gains and dividends are still going to be at 20%, plus an extra 3.8% if the Medicare tax applies to you, which we're going to be talking about. And then I want to mention employment taxes, because they normally don't talk about employment taxes, and they're pretty high. If you earn more than $128,700 a year, then your employer has to put up employment taxes, and you have to put up employment taxes. And when you add those together, and we go to page 11, the total cost after tax deductions is about $16,098. So if you're on the payroll of your own company, or you have a family member on the payroll, they're making $128,700 or more, they've paid employment taxes of $16,098. Now, employment taxes are not due on dividends that you receive from an S corporation. So if you have combined business and professional income of $150,000 and you've been taking $128,700 of wages and the rest in dividends, you may want to move the wages down and have more in dividends to reduce the wage check. But on the other hand, if you want to maximize your pension planning, which we'll also talk about, you're able to count the first $270,000 of your wages. So the employment taxes on that, based upon the 14% rate on the first $128,700, and then the excess rate above that is going to be about $19,708, just so you know. The next paragraph there, though, if you want to pay your child $6,000 in wages so that your child can set up a $5,500 Roth IRA and have an extra $500 that they feel like they earned, then it's going to cost you $294 in employment taxes and the child $459 in employment taxes, and your child may or may not be subject to federal income tax. But I point out early here that you can pay your child, make them work. It's a great maturing opportunity for them, and you can have them open a Roth IRA that can then grow tax-free. It's creditor-proof, and you can do the same thing for your parents and for your in-laws. So having a lot of people work in your practice can be a good idea. Now, the tax rates on page 12, I've given you an idea here of what you're saving just from the tax rate reductions. Let's say you make $50,000 a year. In 2007, and you don't have, and that's above the standard deductions and expenses that you would have been able to deduct. In 2017, you would have owed $3,448 in taxes. In 2018, it's $2,739. The total savings are $709,000. $709, which isn't bad. So, if you put your children on the payroll and they do work and you pay them $50,000, you may be saving 40% after 40.8% because of the 37% plus the 3.8% Medicare tax, and then they may pay a tax of 12% plus another 14% in employment taxes. So you still can come out way ahead, and they can feel like they're earning their way. Now, if you have net income of $50,000 a year as a married couple, your tax would have been $140,000 in 2017. Now it's down to $117,000. You've saved $22,000 in all just from the tax break. And note, you're still in the 35% bracket now, up to $700,000. It's only at $700,000 that you break into the 37% tax bracket. If you make $1 million, then your savings just from the tax bracket changes $42,000. So that's pretty good news. And it's comparable for the single filers, which I'm showing you on page 13. Page 14 gives you the actual rates, as does 15, 16. So you have them there for your convenience. Then keep in mind on page 17, you've got the 3.8% Medicare tax if you're unmarried with income over $200,000, or if you're married with income over $250,000. And this is now the main marital penalty. Because if I make $200,000, my significant other makes $200,000, neither of us pay Medicare tax, we get married, suddenly we owe 3.8% of $150,000, which makes the wedding reception a little bit more expensive. As I said, the combined tax rate for your high earners is now 40.8% versus 43.4%. And now let me talk about the kitty tax. Now this has nothing to do with cats or kittens. It's not as warm and cuddly either. If you have a child under age 18 or a full-time student under 24, and they have unearned income, which means they have stock in your S corporation, they have stocks in bonds, then to the extent that they have income over $12,500 that's passive income, it gets taxed at the highest tax bracket. It's no longer at the parent's tax bracket. It's now at a flat 37%. So you have to watch out for that. That also applies to complex trusts, which are irrevocable trusts, which are taxed at their own separate bracket. Most of our clients have trusts that are not taxed at their own bracket. Most of our clients have trusts that are taxed at the client's bracket. But if you have a complex trust, it is going to be taxed at 37% above $12,500 plus the 3.8% Medicare tax. So I've got the slide here at page 18 for your kiddie tax, just so you can see the kiddie tax on ordinary income and on capital gains. Here's the final tax. That's the sales tax on rent. It went down from 7% to 6.8% for most Floridians. The state takes 5.8%, and most counties take 1%. So paying rent costs you sales tax, but it is tax deductible, and if you're at the 35% tax bracket, it really only costs 4.42%. And the more rent you pay, the more depreciation deductions may come back on the other side, which we'll also discuss later. But these are all interrelated taxes and calculations that impact decision making. Now, let me also mention, before I forget, and as we gradually build into these rules, that your medical practice may pay rent to a building entity, and we would keep those under separate companies because we don't want to lose the building if there's a lawsuit against the medical practice. And while large corporations with revenues over $25 million have a limitation on their interest deduction, small companies don't. So you can put a big mortgage on your office building, deduct the interest income, and in addition, have your medical practice guarantee that that mortgage, and give the bank a lien on your medical practice assets for all the amounts owed on the building. And then if there's a malpractice action, the bank can call the mortgage in, collect the medical practice assets, sell them on the courthouse steps, and it's very hard for the judgment creditor to reach anything. By the same token, you may be able to have your practice owe you money. You're not going to be able to write off the same amount of home mortgage interest as you were in the past. It's gone down from up to $1 million of acquisition indebtedness to $750,000 for future loans, and you can no longer write off your line of credit, your home line of credit. So you might want to increase your commercial building loans because all of that interest is going to be tax deductible. And I'll be repeating this later. Now I'm going to go into the personal income tax rules. And I thank Brandon for making this so easy now that we can actually understand it. Obviously, all your income is counted, and then there's certain expenses that you can deduct no matter what. These are not the itemized expenses. We call them the above-the-line expenses. And these include ordinary and necessary business expenses if you have an active business in your personal name, which we discourage, or an active rental activity, which Brandon's going to talk a little bit about. Your retirement plan contributions that your employer is able to allow you to make on your 401k. If you're a school teacher, up to $500 for buying books and supplies for the students. God, that just makes me want to be a school teacher just for that write-off. Alimony, if you were lucky enough to be divorced prior to December 31, 2018, it is time to see the marriage counselor if you may pay alimony, because alimony is no longer going to be tax deductible if it's established after December 31st, 2018. So that's going to be a big issue in a lot of marriages. Interest on student loans up to $2,500 if you're a low earner. Higher education expenses of up to $4,000 if you're what we call a low earner. And other items on lines 23 through 35 of Form 1040, and there they are. Now, you can take out your Form 1040, listen to this webinar again, which will be on YouTube, and go over your own situation, and you'll get an understanding of how this works for you. It's a great idea for you to go over the main pages of your Form 1040 with your accountant. You will be able to understand this if you combine these PowerPoints with that. Now, the standard deduction means that every taxpayer, if you're married, gets a $24,000 deduction, whether you have these items or not. But you can only deduct these items if they exceed $24,000. And what I have here on page 24 is, no, it's not a Christmas chart, even though that's the Christmas colors. This is a chart that shows you which itemized deductions were cut out completely, and those are in red, The home equity debt interest is no longer deductible, and miscellaneous itemized deductions, which we'll talk about later, are no longer deductible. Unfortunately, that includes any legal fees and any investment advisory fees that you pay for non-business situations, and that's kind of sad. And moving expenses are no longer deductible. In yellow, we have the items that are still deductible, but which are capped or reduced. I'm sure you heard in the news, state and local taxes, you can only deduct up to $10,000 worth. So if you have $20,000 a year of taxes on your house, get a smaller house because it's no longer deductible. And also your mortgage interest, if you get a new mortgage on a house going forward, it's only going to be, or if you refinance what you have, the cap's going to be $750,000 of debt, the interest on $750,000 of debt. Brandon, does that include a second home?
It does. You can have a second home, but you're still limited to that $750,000 amount. So it's reduced down from $1 million.
Now, if you're told, oh, and also, let's go back down to green. Your medical expenses. Brandon, does that include elective cosmetic surgery?
It doesn't. It has to be, if you voluntarily undergo a cosmetic surgery, that's not going to be deductible as a medical expense.
What if you're really ugly and your spouse is going to divorce you this year so that they can write off the alimony, unless you get that?
Probably not deductible. That's probably going to be considered voluntary.
Okay. Now, charitable deductions are itemized deductions. So a lot of clients are not going to actually save money by donating to charity unless you use a couple of the techniques that we talk about. Those techniques are bunching your charitable donations so they go over the $24,000 itemized deduction if you're married, or having your charitable donations be paid by a complex trust, because a complex trust can in effect deduct them. And then finally, the limitation phase out of itemized deductions, that's now gone. So that's a really good thing. So there are certain deductions, such as charitable deductions, if you're a high earner, you weren't able to take them, even if you itemize, and now you will be able to. So the next page, we have another tax return page where you can see where these things fit in. Page 26 is also another tax return page where you see these items, what they're being changed to. And now page 27, bunching charity, and I'll give you the example. Dr. and Dr. Jones have a $24,000 standard deduction, but when you pull up everything they normally pay a year, it comes to $24,000 a year. So they're not going to get any additional deduction. But instead, they save their charitable deductions, and they do 5 years of charitable deductions. Instead of $5,000 a year, they do a $25,000 charitable deduction. And that causes their itemized deduction to be over the limit, and they end up saving 37% of the extra charitable deduction. So let's say they normally give $5,000 a year to charity. They can just put $25,000 into what we call a donor advised fund. They can control that money. The donor advised fund is actually a charity technically, and then when they transfer the money from the donor advised funds to their charities once a year for 5 years, they get the ethical credit, they get the recognition, and also you don't have to fund your donor advised fund with cash. You can put appreciated stocks that you otherwise would have paid capital gains on. So you want to make sure you bunch your charity and other itemized deductions. You can do the same thing with your property taxes to some extent. That's why you want to talk to your CPA. I wanted to mention homes are usually not a good investment. So whoever told you that your home is a great investment, you really need to recheck that. If you think about the cost of the home and you look at the fact that the home is a year older every year, the building's depreciating in value, it's just not what you thought it was. And now that you can't deduct the interest on the home, you can't deduct all the property taxes, it's a lot worse than what it was. So you want to think about possibly converting your vacation home to a rental home and actually renting it out so you can write off all the interest. You'll have a depreciation write-off. You'll be able to write off the taxes, but you actually have to make it a rental property, and you personally can't use it more than 10% of the number of days it's rented. So if you rent it 100 days, you can only use it 9.5 days. There's more in the slides, but I just wanted to make sure I mentioned that. So A few other new personal income tax laws on page 33. You can deduct up to $5,500 put into an IRA as long as you have that much income. So everybody, no matter how wealthy, no matter what their income tax rate, should be setting up an IRA every year. And like I said, children should be encouraged to work, and they can open a Roth IRA, which is then never subject to income tax their whole life. And if you, Brandon, if you put in $5,500 of contributions each year at 4% growth into a Roth IRA, it would be worth $842,000 in 50 years. Just one contribution would grow to $317,000. Could that be true?
37,000.
Oh, 37,000. That's still pretty good numbers. Wow, that's nice. Okay, page 34. Talk to a good actuary. Don't talk to somebody who says that they sell products and that they're also a pension advisor, because that advice will not be as good as the advice that you get from an actual actuary. Most of the good CPA firms have great relationships with a sophisticated actuary, and you might do best forming a defined benefit plan or a cash balance plan and putting up to $200,000 to $250,000 a year in for a high earner individual. What they need is your census, the name, date of birth, date of hire, date of termination, W-2 compensation amount, hours worked, and ownership percentage. If you give them that information, they can give you a chart to show you what goes into the plan for each person. And you can see this example of a 401k plan where Charles Allen was going to get 62% of the money going in. The staff was going to get the rest, and for the staff, it's tax deductible. And they don't all get to keep it because those who leave within 5 years of starting leave some on the table. But these same people, if you did a cross-tested profit sharing and defined benefit plan, Charles Allen may be able to put 90% of the money in. He might be able to put in more than he earns even right now. So you definitely want to look at that, and there's good reasons to. Capital gains tax rates, as I said, are pretty much the same. The Medicare tax on page 29, you can refer to this to see what you pay Medicare tax on and what you don't. Notably, you don't pay Medicare tax when you pull money out of an IRA or a pension. You don't have a Medicare tax on income that would have come out but for going into a pension, and you don't have Medicare tax on S corporation dividends. That's that 3.8% tax. I'm going to also mention your 529 planning. You can now put in money to pay for your child's kindergarten through high school tuition. So if you plan up to $10,000 or tutoring or homeschooling expenses, so if you plan on page 41 to put a child who was just born through kindergarten and high school, you can put $75,000 into a 529 plan. If it grows at 6% interest, it will pay for those items exactly with $1,800 left over for college. So that's a really good thing because you never pay any income tax on the growth, and it's creditor protected. And if you want to do forward gifting using your $15,000 exclusion, you're allowed to forward gift for the year of the gift plus 4 years, so you don't have to file a gift tax return. So they really fit this nicely. It's a great boon for people who can afford to have 529 plans. And even if you end up spending the 529 plan for somebody else's child or some worthy niece or nephew or grandniece or nephew, you get the tax advantage. Or if you pull it out for yourself, at least you didn't pay taxes for a few years. Even with a little bit of an excise tax, if you pull it out for non-educational expenses, it can be better than a lot of different tax planning vehicles, including one called the variable annuity that we're not all that fond of. Okay, page 42, I want to talk now about the business entities and business planning. On the left-hand side, you have the C corporation. This is taxed as a separate entity, and it was, for professionals, a C corporation was taxed at the highest bracket, 39.6% on the first dollar of net income. For a C corporation, the income goes in, you deduct the deductible expenses, and what's left gets taxed at the corporate level. Now, the highest corporate level went from 39.6% to 21% federal. So, of course, the blue chip companies and the companies that make a lot of money that were in the C corporation format are very, very happy. But if you're a Floridian in a C corporation, you're going to have the 21% federal tax, You're going to have the 5% Florida tax, which is taxed on net income of a C corporation. That is partly deductible, so you end up with a net effective tax rate of a little under 25%. And then when you pull the money out of the C corporation, it's usually taxed at about 20%. It's not so good. It's not so good. Unless you're planning to really grow inside the company, you can take advantage of some income tax deductibility of Medicare, of medical expenses, but it's not the greatest thing. Now, the S Corp still lets that income flow through, and it goes on the personal return. To the extent you have salary, it's treated as salary. To the extent it comes out as dividends, it's treated as dividends, not within the Medicare tax. But here's the nice thing. The flow-through entity of an S corporation, if it's situated properly, will now qualify for the 20% of otherwise taxable income. So instead of being in the 37% bracket, plus 3.8%, if you qualify for this, you will now be in about the 29.6% bracket, plus 3.8% Medicare tax. So I guess 33.4 or something like that. So the question is, do you have a flow-through entity availability? And that can be taxed as an S Corp, a partnership is similar to the S Corp, or a proprietorship. If you qualify for the flow-through tax deduction, you'll pay only tax on 80% of what you would have paid tax on. So that's vitally important, and hold that thought. Page 43, here's that flat tax for for C corporations, just so you see it. And if you had a C corporation that was only earning $100,000 a year before, that's going to cost you $15,000 in taxes, because you're now at a flat bracket, 21%. Actually, I got that wrong. It's going to cost you $6,500 in extra taxes on the first 100, but then above that, you save a lot of money, as you can see on page 43. Page 44, I've given you the different categories that people normally are. Number 1, regular employee, receiving wages, W-2 wages, you've got the employment taxes, you've got the Medicare taxes, you're stuck, and very few deductions. On the other hand, number 2, if you're an independent contractor, your income goes on what we call a Schedule C of your tax return. You typically have more things you can deduct, and depending upon your income level and what you do, you may qualify for that 20% tax in column 2 that you would not have qualified for under column 1, which is what Brandon's going to discuss. Number 3, the partnership, very similar to number 2 and number 1. It's a separate entity, but the income comes through to the employee by K1. Number 3, an S corporation that might act as an independent contractor, which we'll be discussing. That can also be advantageous because it avoids Medicare tax on the dividends, as I said, and it also is less likely to be audited than a Schedule C, so you reduce the audit cost risk. And in addition, it may qualify for the 29% or 29.6% flow-through tax deduction. Then you have an S corporation that's actual practice, which is very similar to column 3, and a C corporation practice, which is similar to column 4, except that the corporation, again, is subject to that double tax. So these are our choices, and in this first 30 minutes of this webinar, you've got a pretty good understanding of this. I'm going to just note here that if you need to go, because we promised that this would be half an hour and broke our promise, we'll be picking up the recording of this webinar for YouTube tonight, and you can watch it on YouTube after you watch your favorite Mariah Carey video. Page 43, page 45, I've shown you the Schedule C. If you are a Schedule C taxpayer, think about setting up an LLC to limit your liability, and read your Schedule C on your tax return so you can see what you're able to deduct and talk to and plan with your advisor accordingly. If you have rental property, that shows up on a Schedule E, and I've got the Schedule E here for you, just so you can become familiar with what your situation is. Again, I would rather have a rental property than a vacation home, because a rental property can go on my Schedule E, all the interest is deductible, all the taxes are deductible, and even if there's a net loss, I can write it off if my spouse is a real estate professional. If my spouse or I are not real estate professionals, and the interest deduction and the depreciation deduction exceed our rent income, what happens, Brandon?
Then you're limited. You can only offset passive losses against other passive activities. You can't offset those losses against your ordinary income that you would earn in your practice.
So it stores up, and then you can't take the loss until you sell the building.
Right.
So, but if your spouse will spend, how does that work?
So your spouse has to spend, I believe it's 50% of the time, of her time working in the rental activity, or over 750 hours working in that activity.
But one or the other?
I think it's actually both. I misspoke there. So it's 50% of her time spent in the activity plus at least 750 hours in the activity.
So it may be worthwhile if you have 10 or 20 rental houses to have your spouse do that. And a lot of spouses have enjoyed taking the real estate broker course, the real estate realtor course, becoming mortgage brokers, and actually being able to get commissions every once in a while when they help with a home sale. Page 48, I still think that this is going to be the optimum arrangement for most small group medical practices. Each doctor and possibly their spouse owns an S corporation, could be an LLC taxed as an S corporation. They own the practice entity, which is taxed as a partnership. The income from the partnership flows through to the S corporation. Each doctor can decide how much salary to take, how much in dividends to take. You can allocate the income based upon certain activities within the partnership. Doesn't have to be pro rata the way it has to be with an S corporation. So there's a lot more planning that you can do with this than with a single S corporation, and you have the employment tax savings. Page 49, just another way of looking at it. If you have this S corporation entity, where's the money go? It can go to the pension plan, children on the payroll, wages to the doctor, wages to the doctor's spouse so that the spouse can do a pension contribution. Does the employment tax cost outweigh the advantage of the pension contribution deduction? Sometimes it does, sometimes it doesn't. That's where the actuary can come in to set the spouse's salary. Dividends are advantageous. And then rent, we talked about. And if you owe interest to related parties, if your parents loaned you money and you pay them interest at 10% because it's an unsecured loan and they need the money to live on, that basically is an interest-free way of helping your parents and making sure that their investments are well preserved and not wasted on something other than you. Now, page 50, I'm going to talk to you for a minute about the flow-through entity deduction. But what I want you to see here is you've got a doctor or doctors who own a medical practice in an S corporation. On the left, they can pay themselves pension, salary, children, parents. On the right, they could have a C corporation formed, which could do the marketing for their practice, could do the IT work for their practice, could do management for their practice. They could pay it a tax-deductible payment, which reduces their income by at least 37% if they're high earners, and the C corporation is taxed at 25%. Alternatively, an S corporation could be set up to do billing, factoring, management, IT, etc., and it might be owned by the children who would be in low tax brackets, and if they're over 24, then we don't have to worry about the kiddie tax, the parents, or even the doctor owner. And the income that would go to this company on the right bottom may qualify for that 20% deduction, because the new law says that while your deduction from a health corporation or a law corporation or an accounting company is limited, as Brandon will discuss, it is not limited necessarily from a management company or a billing company. So one question is whether you have enough fair market value management, billing, advertising fees, IT fees to be paid to a non-healthcare company, and would that non-healthcare company be able to qualify for the 20% deduction? And that's the big question. And we're not going to have regulations for years here, so this is probably going to be a gray area, but this is what a lot of medical practices are going to be considering doing. I'll give you another example. You have a surgeon. He earns $300,000 a year. His wife does not earn They're under 307,000, so that they would be entitled to the 20% the 20% deduction if they had a passive business. So he says, I don't want to be an employee anymore, making $307,000 and being subject to my share of employment taxes and also a full tax load of the 30-some-odd% bracket. I'll go ahead and become a contractor. I won't be an employee anymore. I'll set up an S corporation. It will be a contractor. It will do work for 2 or 3 different medical practices. It will make $307,000. It will pay me $100,000 as salary. It will pay me $207,000 as dividends. The $207,000 will not be subject to employment taxes and will qualify for a 20% deduction. So you've reduced taxable income by $40,000, which in a 25% bracket, that's $10,000. This is not without risk, because the IRS may come in and say, hey, you should have taken it all out as salary. They may even penalize you. But this is the type of thing that people are looking at and thinking about. Page 51 for the advisors. We think there's a big risk anytime that somebody is a partner in a partnership, I don't care what kind of partner they are, and they're also working in the partnership, those distributions they receive, those K-1s, we think that you've got a big risk of employment tax there. So S corporations are preferred for this reason. I'll be glad to send you more information on it. Page 54, the 179 deduction. If you're a doctor's office and you have the need for a $400,000 MRI machine, last year you would have had to write that off over a number of years. This year you get a $400,000 deduction. You need a car with more than 600, that's more than 6,000 pounds in your practice, such as a Porsche Cayenne. That's a 100% deduction, as long as it's 100% business use. So you have to look at your 179 planning. Because if you say, hey, you know, I've got a medical practice, but my income is way over $307,000, so I can't get that deduction. Well, what if you bought a new MRI machine, and what if you got a defined benefit pension plan? You could put $250 into the pension plan tax deductible, deduct $400,000 for the MRI machine. That reduces your income by $700,000. If what's remaining is $307,000 or less, and that's all your family income, then you may really cut your taxes this year if you want to do that. So these are the types of things that are available. A little bit more information about real estate, and it's important to meet with your CPA and decide exactly how much rent to pay. Sometimes you don't have to pay any rent at all for the building to be considered as active if it's identically owned with the ownership of the medical practice. And I've given you the code section there, and there's a regulation on it and a case that I've talked about here on page 60, page 61. Page 62, here's another example. Medical practice on the left sells its accounts receivable for 78% of their face value to a factoring company. Most of these accounts receivable are letters of protection received when doctors do work for personal injury victims. The factoring company gives the money back to the medical practice. The factoring company then collects the money, and it makes a lot of money. It's owned by the doctors and a child who runs it. The child's in a lower tax bracket. It may, maybe not, but it may qualify for the 20% deduction, and it gets that money out of the medical practice for creditor protection purposes, all these accounts receivable. The factoring company borrows money from the family limited partnership and pays a reasonable interest rate, so the family limited partnership also gets money. If you don't want to give ownership directly to the child, you may be able to set up what's called a 678 trust, which is taxed at the child's bracket, and it's held for the child, but it's still a creditor protection child that the child and their future spouse and even second future spouse and third future spouse can't get access to. Okay, so Brandon, I'm going to turn this over to you now at page 63 and have you give us more detail on the flow-through entity planning. We'll be talking more about the flow-through entity planning on our webinar next week that everyone's invited to. Take it away, Brandon.
All right, so the new tax act, it added a new section. It's section 199A, and under this section, you get a 20% deduction on your qualified business income. Now, that's income from LLCs, S corps, partnerships, Schedule C, and E taxpayers. So if you're one of those entities, instead of being at the 37% highest bracket, it's now reduced to effectively a 29.6% bracket. Now, if your income exceeds $315,000, if you're married, or $157,000, if you're single, it's subject to some limitations. Now, the main limitation that's going to apply to doctors in the health industry is if you're in one of these specified services, trades, or business and your income exceeds that amount, then you can only deduct a certain percentage of it until you get over $415,000. Once you hit $415,000, you don't get any deduction at all. So that's something to consider when you're, when Alan talked about planning. If you're close to those income levels, what can you do to get below that? And then what can we do to, reduce it significantly so we can still take advantage of this deduction? Here on the next slide, we just kind of have a brief overview of what it might cost if you are over the deduction. So on the left-hand column, you can see you have $415,000 of income versus $315,000 of income. Then at the very bottom, you can see the effective tax rate on those two levels of income. And the first $315,000 of income, if you have the pass-through deduction, you only pay $56,000 in taxes. If you don't have the deduction, then you pay $75,000 in taxes. So you're really costing yourself about $18,000 or so by not having the advantage of this deduction. So you really want to make sure you plan for it, and if you can get this deduction, do everything you can to take it. Now on the next slide, we just have the list of those specified service businesses that you're subject to the limitation to if your income exceeds the $315,000 amount, or completely phased out of if your income exceeds $415,000.
Okay, so let's take a look at these, because this is the really difficult gray part of this law. If I earn more than $415,000 a year and I'm married, in total income between my income and my spouse's income, then my income through a health company is not going to qualify for the deduction. If I'm a veterinarian, is that a health company?
I think it probably is. It's really unclear.
What if I'm a tree surgeon? Is that a health company?
That's a little less clear.
What if I'm a billing company and I do billing for health companies?
I think that's probably not considered health, but it might be considered accounting. We don't know. We don't think it's going to be considered accounting, but it's just something to think about when you're considering this.
What if look at what is financial services under number 9? What is investing, trading, or dealing in securities, commodities, etc.? Would that include a factoring company?
It's unclear.
So normally, when a law like this comes out, there's a staff report written on Capitol Hill about what Congress thought the law was about. Normally, that's not going to help us because we have no clarification in the Senate report or the House report or the Reconciliation Committee report as to what these items mean. We also know that under the new Trump administration rule, the IRS can't promulgate a regulation unless it eliminates 2 regulations, I think, right?
Something like that, yeah.
Something like that. So we're going to have a very gray area until regulations come out, and the IRS is quite likely to be a lot more taxpayer friendly than it's ever been in its entire history under the Trump administration. I just don't know what happens 2 years, 3 years from now. We'll finally have a tax court judge look at one of these and say, yeah, I think factoring is a financial service industry, and I think billing for healthcare work is healthcare. And those taxpayers who got audited end up paying back the tax and possibly penalties, maybe not. Or maybe it goes the other way, and then once the regulations come out, then we may have to unwind a lot of these things. It's going to be a very interesting time.
It's also interesting that these entities come from Code Section 1202, which really taxpayers started using about 3 years ago. So I read an article recently that said that some of these cases involving 1202 might be reaching the tax court about this time, and they might actually consider speeding some of these up so we can get some guidance for purposes of Section 199.
Yeah, and I hope we don't get guidance, but that's another thing. Okay, so Brandon, sorry to interrupt. Go ahead, page 67.
Okay, we'll actually go on to page 68. 67 is really just an example and an overview of what we have. But there's also a second limitation to this. If you're over that $315,000 level or $415,000 level, your deduction, which is 20% of your qualified business income, is actually limited to the greater of 50% of the W-2 wages that's paid by the qualified trader business, or the sum of 25% of the W-2 wages plus 2.5% of the unadjusted basis of property, which is really just the cost of the property that you have in your business. Now, that has to be, they refer to that as qualified property, and that's defined as property that's held in the trader business and used in the active conduct of that trader business that hasn't exceeded its depreciable life. So if you have extremely old property that's 40, 50 years old, it's not going to be considered qualified property. But if you have a newer building or a newer vehicle or equipment or MRI machine, that's going to be considered qualified property since you're still depreciating it, and you can count it for purposes of this limitation. So on the next slide there on page 69, we just have an example of how this might work if you want to get into a little more details there. On the next one, we define what W-2 wages mean. So it's actually paid by the qualified business to employees or to the owner of the business. So it includes not only what you pay yourself, but also what you pay your other employees. In the next slide, we also have what qualified property is defined as under the statute, if you want to take a read there of what the technical definition is. Then
let's skip this one.
Yeah. Came up with a chart if you really want to get into details, and now finally we get to...
But that chart, no joking aside, if you are a tax advisor, these materials and the article that we are publishing today on the Lineberg service, which we will send everyone, but mostly that article and this chart may be all you need to know. It's everything that Brandon and I know that anyone knows about this law. And Brandon spent, what, 70 hours probably?
Yeah, almost a week or so.
Probably a week on this, so go ahead.
Yeah, so here we have, potentially what can we do if we're near that flow-through income level, the threshold amount of the $415,000. So let's say we have Dr. Doe here who's earning income of $300,000 through his practice, and he's also receiving a salary of $125,000. So he has taxable income of $425,000, which is over the $415,000 amount. So he is not eligible for the Section 199 deduction. So what can we possibly do to get him eligible for that deduction? Well, one idea we had is, okay, we can gift or sell half of his interest in the entity to a trust for his wife and children. So then he's still receiving the same salary of $125,000, but he only is allocated $150,000 of the income from the practice, and the trust is allocated the other $150,000 of income. So now Dr. Doe's total taxable income is $275,000, which is under the limit, and he qualifies for the 20% deduction. Now, it's also noteworthy that the trust is a separate taxpayer, and under this new Section 199A, the trust can also take a deduction. So both Dr. Doe and the trust for his kids are getting the benefit of this 20% deduction.
And to the extent that the trust has income that it pays to the children, then it will be taxed at the children's lower level.
Right.
So we're going to, and to the extent that this trust donates to charity, that's going to be, in effect, deductible. So we're going to see a lot more complex trusts in this type of planning, and also a lot of what we call the 678 trust, where the child is considered to be the owner of the trust for income tax purposes, even though the parents control the trust, which is the way I've liked it as a parent.
And in the next, we just have some excerpts here from the article that Alan referred to that's going to be published today in Lineberg Information Services. So you can just read through the summary we have, and we also talk about some of the planning ideas that we've discussed. And, one of those that Alan mentioned was increasing your pension contributions to get yourself under the income limit. Another idea is to move income into C corporations and pay deductible expenses to get below that limit. You can also buy a new piece of equipment and take a 179 deduction, or use the bonus depreciation under Section 168. We also just discussed the gifting or selling part of it to a complex trust for your children or your wife. And there's also the ability to actually separate the specified service trades or businesses from items that are not specified service trades or businesses. So that's why we discussed about having a factoring company or a management company or something similar, separate and apart from your practice, that can qualify for the deduction.
Okay, then there's numbers you can review at page 81, and we can also talk very briefly about a 1202 company. This is a C corporation in the 25% bracket, where you can sell the stock of the company tax-free. So you do get the advantage of the lower rates, and then you accumulate assets within the company. It accumulates value, and then you sell this company tax-free. But the problem with the 1202 company is that it has to be what we call a qualified small business. It has to be a real business, and the assets of this business have to be real business assets, not stock and bonds. But a possible idea, Brandon, what do you think about this? A doctor with a large practice and a child who's a very talented advertising agency employee form a C corporation, which provides advertising services for the medical practice, and it invests in billboards. So whenever it gets money, it gets a billboard, and the billboard is then licensed out the way billboards work, $500 a month, $1,000 a month. And then after 5 years, it's got $1 million worth of billboards, and a billboard company buys the company. That might work, right?
Right, yeah.
On the other hand, if it buys computers that are used by the practice, it can't be leased to the practice under the 1202 rules. So we're looking for everybody's ideas, and I will give a free lifetime subscription to the Thursday Report to the people who have the best ideas about what a 1202 company can do. So the 1202 company could receive a management fee and then invest in a convenience store. The investment doesn't have to be in the same business that the 1202 company makes the money in, but it can't be real estate.
Right.
And it can't be property that it leases.
Right.
It could be intellectual property, and then when you later sell the medical practice, the buyer pays a lot for the intellectual property company. That could be another use of a 1202 company. So there's going to be 1,202 articles about 1202 companies, but Brandon and I wrote the best one, and we're going to send that article out today as well. The article that we've written for Lineberg Information Services on 1202. Okay, now that we're halfway through the 30-minute webinar, I'm just going to say a few more things, maybe 3 minutes here, and thanks so much all of you for staying on. I know you're actually doing other stuff and listening in the background. Yep, that's you, Stan. You too, John. You too, Mary. Anyway, page 87. Make sure the doctor's judgment proof. There is no excuse in this day and age in the state of Florida for having a doctor walking around with a lot of assets that a creditor could take. Use page 88. Carry it with you everywhere you go. It's the exempt assets. Keep your assets in exempt form. You can restructure now. You have a business reason to restructure into different entities that can be owned by different trusts for creditor protection purposes. When you engage in these activities, set up separate LLCs for each activity. Don't put your family limited partnership into a business that causes liability and it gets sued and loses all of its assets. So we like separate subsidiary LLCs, which can be disregarded for income tax purposes, but are very important for creditor protection purposes, as you see here. Talk to the doctor about wages. Have a written employment agreement if the doctor is the head of household. Put the wage money directly into a creditor protected vehicle so that we don't worry about wages being lost to a creditor. Maximize 529 planning. There's an article here we'll be glad to send you on unconventional uses, which are really good for income tax planning purposes. If you're going to get divorced right away. If you're married to a psychopath and you're not a psychopath, get out. If you're a psychopath and they're not a psychopath, stay in. But talk to your clients about what they're doing on the marital planning side. If Marcia dies, does she want me to have all the assets outright? Or does she want me to have the assets in a trust that have to pass for our descendants on my death? Ask your clients this question, and they'll be surprised to learn that they're not that well protected in many areas. Talk about using what's the new $5,600,000 gift tax exemption that was just added. I'm sure everybody here knows a lot about this. Think about having a trust set up for your spouse that provides for your spouse's health, education, and maintenance as long as you're married, or for your next spouse's health, education, and maintenance if you're not. It's not your trust. You're not a beneficiary. Your creditors can't reach it. It's not subject to estate tax. It could own a 1202 company, et cetera, et cetera. There's a lot of exciting planning that we can do here. So consider the estate tax planning. Understand that you now have the $11,200,000 exemption. It might actually be $11,180,000 because of the chained CPI situation. Consider using a Nevada trust if you want to be able to be a beneficiary of the trust for more creditor protection planning. Don't own 100% of an LLC. Have multiple owners so that if one owner is sued, the creditors can't reach into the LLC. Don't inherit directly. Have your parents leave the assets to a trust that they can form or you can form that can benefit you without being subject to estate tax and divorce claims and things like that. Keep plenty of debt against the medical practice. Just ask your CPA, how much can my medical practice owe me without triggering tax? Okay, call your lawyer. Give me a promissory note payable to my family limited partnership for that amount. So if my PA gets sued and gets a judgment against it, the first monies go to me or go to my family partnership. Put a UCC financing statement in place. This is all in alignment with what we're doing here. I've even got an example for you. I've got plenty of examples. You guys all know I'm way over my head in examples here. Consider buying accounts receivable using factoring companies if you are dealing with letters of protection in medical practices. Consider separating the practice into separate companies for liability purposes. You could have a real estate company, a family business, the practice company, the intellectual property company, management company, factoring company. The more the better as far as I'm concerned, but at least consider these and consider that the ownership should be properly aligned. Have proper buy-sell agreements in place. There was a slight modification in the taxation of life insurance, which is advantageous in this new tax act, but so often we see clients who have the life insurance owned improperly, so it's going to be accessible to creditors and it's not going to give the right tax result in a buy-sell agreement as indicated here. And keep a list and check it twice of the things that you can do for your practice, yourself, and your clients before year end. We have a law clerk here named Joshua. He's watching this webinar. He's going to come up with a checklist of things to do. We're going to send it to all the participants tomorrow, which is his last day of spending 3 very enjoyable weeks here. Joshua, you did a great job. If anyone knows of any good college students who would like to intern for us, please let us know. I've got an asset protection checklist here, pages 1, 2, and 3. Please come and talk to us, see our flow-through entity webinar next Tuesday, January 9th, 2018. Let us know if you have any questions of any kind on anything, and thank you very much for checking in to this 30-minute webinar that only ran an hour. Of course, it's the reverse when you get a bill from us, but at least this time you got a whole hour for 30 minutes of your money. May the rest of your day and evening be billable. Thank you very much.